With the ongoing global conflicts, there is a lot of economic uncertainty right now. A common belief is that external crises will naturally lead to a property market crash, creating opportunities to buy at lower prices. Today, we are going to look objectively at the data to uncover if global crisis actually caused Singapore property market to drop the same way the stock market behaves. To give you an overview, we will be analysing the period from 1996 to Q1 2026. Over this period, I have plotted 6 major crises. 1997 Asian financial crisis, 2000 to 2001 the dot-com bubble burst, 2003 the SARS outbreak, 2007 to 2009 the global financial crisis, 2010 to 2012 the European sovereign debt crisis, 2020 to 2022 COVID-19, and also 2026 Middle East tensions, Iran versus Israel and US. Now let's start with the HDB market. From the HDB graph, just in case you don't know, the bars represent the volume of HDB sold and the line represents the price per square foot. And we're looking at the chart, it was a really tough time for people back then from 1997 to 2003 because the crisis was so packed together. Let's start with the Asian financial crisis. Now for some background, the property boom in the mid-1990s resulted in high demand for new flats, leading HDB to heavily increase constructions. When the Asian financial crisis struck in 1997, demand fell sharply, leaving HDB with 31,000 unsold units that eventually took more than 5 years to clear. But one thing I just don't quite understand is why during this period of massive unsold inventory, the government still added restrictive regulations. Now in April 1997, they limited HDB flat buyers to 2 housing loans, a policy that remains in place today. In May 1997, the minimum occupation period, which is the MOP, was extended from 5 to 10 years before HDB flat owners could purchase a second HDB flat. Now looking at the data, the massive oversupply of flats and strict policy interventions may have been the real culprits behind the price drop rather than just a crisis itself. Let's look further to see if we can draw a definite conclusion on that. Next, we move to the 2000 dot-com bubble and the 2003 SARS outbreak. During this hangover period from the 1997 oversupply and the economic impacts of the dot-com bust and SARS, the government focused on removing rules and reducing supply to prevent the market from sliding further. That is why the BDO system, which is the build-to-order system, was only introduced in 2001. From then on, flats were built only when there was actual confirmed demand. That single policy change altered Singapore's properties dynamics. Since it became a build-to-order system, right, the supply became very stable, and as you can see, the price became very stable too. Although prices creep up slightly, the change was not drastic. I can confidently say that neither the dot-com bubble nor SARS affected price significantly. When the 2007 to 2009 global financial crisis hit, the structural oversupply of the past was gone. Instead of crashing, HDB prices actually trended upwards. By the 2010 to 2012 Euro debt crisis, while Europe faced severe financial instability, the local HDB market was overheating. This is very tricky. Previously, HDB built flats ahead demand, but the BDO system reversed this. While this stopped oversupply, it created a huge problem when demand suddenly returned. Because of this, the government had to introduce anti-flipping rules. For example, the MOP was changed to 5 years across the board, and the no concurrent ownership rule was implemented. Private property owners who bought private properties were forced to sell their property within 6 months of the HDB purchase. Essentially, the crisis between 2007 and 2012 did not stop prices from increasing. In fact, between 2010 and 2012, there was a massive public unhappiness about flat shortages and record high cash overvaluation, the COV. Our government effectively flooded the market with new flats and introduced a mortgage servicing ratio, the MSR, the limit of 30% of your income in 2013. This explains why, despite the crisis, prices continued to climb and until new supply and cooling measures stabilized the market. The price dip in 2018 and 19 was not drastic, suggesting that the market was quite stable at the time. Now when we move on to the 2020 COVID-19 pandemic, the narrative shifted again. BTO construction was delayed and the supply chain was interrupted. Instead of crashing due to the lockdown, the HDB resale index broke record after record. The crisis led to reduced supply, resulting in a price premium rather than a discount. So what does this historical data mean for the 2026 Middle East tensions? Now, I think everyday items will become more expensive, but the HDB market will likely be fine. Historical data indicates that significant price corrections are primarily driven by massive domestic oversupply or aggressive government cooling measures. From 1998 to 2001, there was an oversupply and prices went down. After the BTO system launched in 2001, supply was steady from 2004 to 2006, the prices remained stable. Then from 2007 to 2012, high demand led to an undersupply, so prices went up again. After injecting the huge number of HDB flats completed in 2013, the market faced an oversupply which caused prices to drop. Fast forward to the COVID-19 period and an influx of buyers combined with an undersupply caused prices to rise naturally. Now, one thing for sure, once prices go up, they never return to where they were. It's as if the market becomes even stronger after a crisis. In my next video, I will talk about how crises affect condo and landed property prices. In fact, I didn't even know that there was a capital gain tax in the past. Now remember to like and subscribe, and I will see you in the next video.